Welcome back to Reimagine 2020. I'm Yonah Hochhauser, and today I'm glad to be joined by Doug Leonard, CEO of MainFrame. Doug, thanks so much for joining us again.
Thank you for having me.
All right, well, it's great to be here on this Halloween special, Tales from the Crypto. That's why I'm dressed like this. But Doug, for those who didn't get to see our first interview, you want to give a little background about who you are and how you got into blockchain?
Yeah, you bet. So kind of the high level is that I've been a fan of blockchain since the early days of Bitcoin. When I was in university, I really got interested in the technology side of things, and then it kind of just grew from there. I eventually was working as a mobile developer contractor and was talking a big talk to my wife and saying, hey, I think blockchain is going to change the world to the same degree that the internet has. She says, if you actually believe that, why don't you have a job in blockchain? So that's when I kind of, took a little detour in my career and began working for MainFrame. And then eventually I would be put in charge. And so right now we are about to launch our fixed rate lending protocol into the DeFi space.
Mm-hmm. And so you mentioned the fixed rate protocol. What's the difference between fixed rate and stable rate, like Aave, for those who don't know the difference?
Yeah, so really it just comes down to a minor technicality around there being a possibility that your rate changes. So stable, it insinuates that potentially your loan might be refinanced depending on market conditions. Whereas fixed rate is exactly as it says. There's no circumstance in which it would be refinanced based on broader market conditions.
And how are you guys able to guarantee that in a market that is so volatile as the crypto market?
Yeah, that's a really good question. So by locking up collateral, which is the volatile aspect of it, you borrow against it. And so as long as you keep your collateral vault sufficiently constituted, you're not going to get liquidated, and you basically have, since you're borrowing with respect to a fixed rate, you end up with a fixed exposure to a stable coin. So that's where the volatility doesn't really apply to you when you're borrowing with respect to a stable coin.
And how come other lending DeFi lending platforms that pretty much work the same system where they are locking up that collateral? How come they're not fixed? Why do they go the stable rate route instead of the fixed rate route?
Yeah, so there's a trade-off to be made. You can either have predictability on one hand, or on the other hand, you can have sort of this seamless user experience where with a fixed rate lending protocol, you have to settle the debt on a certain date. And so I think the variable rate lending protocols kind of took root first because it requires less user interaction. And if you've got a product where you can choose not to have any user action versus needing the user to go and click one button, you typically choose the more simple. And so like focusing on fixed rate for us creates a new opportunity for interest rate arbitrage between variable rate lenders. And so this kind of creates a more mature debt ecosystem within blockchain.
Well, if we're talking about more mature ecosystems, I mean, last time we spoke about DeFi, we were talking about yield farming, and it seemed like yield farming was that craze where there was crazy APYs going on, and it seemingly has died down. Is the era of just wild yield farming over?
Well, I think I don't think it's over, but I do think that we've got now a baseline for how long you can hold the market's attention, given minting a new token out of thin air and just giving it to users. I see this narrative around user-owned projects, which typically are either an experiment or some type of fork of more legitimate, higher reputation type team. And quite honestly, it seems like they're able to grab attention for 1, maybe 2 months, and then things really, really die down after that. And so I think what we're going to see in the next phase is some more patient token economics, where they're going to demand more of users before they start giving ownership out, and which means the APYs aren't going to be as stunning, but it's going to be, you know, like small market cap coins are today, is you're taking a big risk investing into an ecosystem before it's fully mature. And then the ones that materialize are going to really, you know, return back some huge multiples to those investors who took that initial risk. Right now, it's really mercenary hot money, where you've got, you know, these large, you know, VC firms or other, you know, type of wealth pools that just come in and just extract value from that ecosystem, and then they're gone as soon as the APYs are, you know, below what they can get anywhere else.
Right. I mean, and during that whole yield farming craze, I mean, that was really that really came to be because there were these new protocols, like you said. They're all fighting for attention. They're fighting for liquidity. They're trying to get liquidity to their protocols. I mean, in the era, in the days when you could copy and paste the protocol, when you could take a Uniswap, copy it, and then make a sushi swap, you know, how everyone's trying to attract liquidity to their protocol. And so they were incentivizing liquidity by giving out these tokens and giving out these crazy returns. So how else can a protocol attract liquidity? Let's say for MainFrame, and how are people going to find MainFrame? How is MainFrame going to attract users when its use case, when its business model, when its entire infrastructure could be copy and pasted?
Yeah, so this is a legitimate discussion that we have internally at MainFrame, and so there's a couple of things. So one, it you know, with any of this stuff comes risks. And so users are going to make a decision based on what their risk profile is. If somebody wants to fork MainFrame and be a non-developer, it seems that there's a lot more hesitation today because of all the rug pulls that have happened. It also seems that people have hit their limits on how early they're willing to throw something into a protocol before it's been tested. You know, so I think that there's a little bit more, like we've sobered up a little bit, and I don't think you're going to find that the teams who are just copying and pasting have the innovative developers or the vision to take a project and really innovate to a material degree. So, or at least I think that the teams with the reputation who are putting their names behind the code are going to innovate and outpace those who aren't. So you look at Uniswap, you know, versus SushiSwap. You know, Uniswap is backed with some big money, and they really didn't need to do a token. But I think, you know, SushiSwap kind of forced their hand. Now I don't know internally. You know, I've got no source, but that's kind of what it looks like to me on the outside. And honestly, I think they could have survived many more years without doing any sort of token. And so it's like, those guys and Hayden, like, it's just there's a reason that they're king. It's the efficiency with the gas. It's the stability of the protocol from like being able to have it formally verified. And when you're parking millions of dollars into a protocol, you know, at the end of the day, safety is what matters. You know, we look at what happened with Harvest, and it's like these aren't trivial amounts of money, and people are going to get wrecked. And I think that there's always going to be this, you know, during the sushi swap era, you know, I had people within my network who were taking their laptops with them out on the golf course because they couldn't be away from it because it was so volatile. They needed to be right there, but they still wanted to live their lives. And so I think when we look at these forks and we look at these sort of flash in the pan type projects, you've got to just exercise caution. It's just, what type of risk do you want to take? And you know, hopefully we'll see some, you know, more legitimate forks that are putting their identities behind the projects and that are kind of complementary to each other. But so far it seems like, you know, most of the forks, you know, Cream comes to mind. It just seems to attract drama. It's like, if you don't have very much to lose, then you can do really stupid things with other people's money and change the rules on them, last minute. And I think that's kind of a recipe for maybe more experimentation than some users think they're signing up for.
Mm-hmm. And this is once again, as it's always mentioned when talking about blockchain, and especially DeFi, this is such a new technology, and everyone, even the developers, are still figuring it out. We're still figuring out that the most efficient ways to code, to write the smart contracts, to make them secure, to have low fees. I mean, this is really in its infancy. So when you look at things like the Harvest Finance, I would say exploit. It's not a hack; it's an exploit. It's utilizing the I'll bet skewed economics that are available, but they played by the rules that were set by these smart contracts. So as someone right now, like you mentioned, you guys launched the test net. When you're developing, and you come from a developer background, when you're developing on this brand new technology, I'm sure you check, recheck, and 1,000 times check over the smart contract, the code. But is it still so fearful when you guys do go live on that mainnet? I mean, are you going to be sleepless that first night?
That's a good question. I try and govern myself in such a way that I don't lose sleep and that I don't need to miss time away from the family. But there are things like if you look at even Paul, who's our lead engineer, he hasn't wanted to do anything else but push through to this last milestone because we're like so close. And so there is that excitement that kind of pushes you to want to watch things and sit up. I was there in 2017 where you're watching your net worth just night, and it's impossible to sleep. It's not healthy. It's like, and so I hope I avoid that type of environment, because I think it's its own way of like it's unsustainable, and potentially you're not there and you're not thinking clearly when decisions need to be made that are really hard if something were to happen. When I look at the opportunity that's in front of us, users are coming, and you kind of touched on this, and I probably didn't answer the question earlier. You're talking about like what is driving people to use these brand new technologies. And so one, outside of liquidity mining, where you're printing a token, which is speculative in nature, but like a utility token that's going to be integrated with the protocol somewhere, people are being driven by economic incentives. But with a lot of these lending protocols, the economic incentives already exist. And so I think there's this like balance between some people in your community are going to want you to just like pull all the levers you can to try and drive all this attention onto your protocol. And if you remember, even from the early days of Bitcoin, that Satoshi didn't want the attention from Julian Assange and these guys, because he knew that if we grew too fast, it would break. And Bitcoin has in its early history these kind of like points where the infrastructure wasn't ready for its own popularity. Ethereum seems to have multiple waves of this type of thing where it's not yet scalable for its own popularity. And so you have these really interesting edge cases that we live in for weeks or months at a time, where gas fees are going through the roof, and then all of a sudden the idea that paying $1 to $2 for a transaction, I was as we were doing some stuff on testnet and testing various things with our protocol and seeing how low the gas fees were, we've done a really good job with keeping those costs low. But like, I'm so desensitized from paying $25 to $35 per transaction for the last couple of weeks. I'm just like, this is awesome. But like the crazy thing is, we get annoyed when we get nickeled and dimed at the bank for every sort of convenience fee, and then we around and we're just like, oh yeah, $50 for pulling out my liquidity from Uniswap, no problem. Like I need to get into the next farm. So I think that these sort of usability experiences are really going to curtail like how many people and what type of people can actually join onto the network within the early phases. And then I think that the economic incentives, you have an opportunity to pour a lot of gas on the fire with your liquidity mining. And you got to be careful about exactly when you do it and make sure that you're ready for that growth and that you've got the infrastructure behind it, and not just like the code base is going to work or it's not going to work, but like the team and being able to for example, we've been testing a couple of the fixed rate lending protocols, and it's working well with MetaMask. It's not working well with a Ledger. And so there's two different types of people who are going to trust their funds on just a direct MetaMask and have kind of that hot wallet, versus somebody who just will not, and it's only parked on a Ledger, and that's the only way that they'll interact with the blockchain. So internally at MainFrame, we've had some discussions, and I can't really comment on what we're going to launch with, but we've had thoughts around specifically launching with certain types of collateral to prevent people from YOLOing in and being dumb. So one of the ideas that I know isn't happening, but that to give you an idea of what we've explored, is Uniswap did this brilliant thing where they launched their collectible sock and the socks token. And so this, for those who don't know, it's a token called socks, and you can go to unisoc something. I don't know if it's io, org, or .com. They seem to like all the different variations, but if you Google Unisocks, you can go and purchase a sock, and right now they're going for something like $3,200.
Wow.
And it's a collectible, right? But like it's just ordinary socks. But yeah, it's cool if you're looking for a Christmas gift for someone and you've got a budget of $4,000. Like there's your idea. But the idea is like we thought, hey, if we came out and we use socks as our first collateral type, one, not very many people have socks, and so somebody who's going to show up, and then the collateralization ratio would need to be really high. They would show up, they would need to have money to burn, which is exactly the type of profile we would want to be experimenting in early days of our protocol. We don't want people who's betting all their life savings on day one. That's dumb. And so there are, I think, choices that protocols have where they know how users within their space think, and I think they can make some interesting choices that might not be the wild ride during week one, but that could teach them lessons to make sure that they're ready for week 2 and week 3.
Mm-hmm. I mean, especially, I think that's very apropos right now, where we're talking about infrastructure that might not be able to handle this massive growth. And I think we should have to look at the recent news by PayPal, where they're saying that they're allowing the buying and selling of Bitcoin, and then everyone got and then so the people got all excited. Oh, PayPal's accepting crypto, and then they looked into it, and you're not actually getting you're not actually just getting an IOU. You're not actually getting the keys. You can't take it off the platform. So then people got very down in it, saying, "Oh, this isn't real. This isn't even real exposure to. You're getting exposed to the price, but not actually to the asset itself." But then now there's a growing sense that whoa, Bitcoin isn't ready to onboard 350 million people right now. If all of a sudden PayPal was actually giving out Bitcoin, that would overwhelm the Bitcoin network, one has to imagine. So where do you fall on the PayPal development with crypto? What are your thoughts on it?
Yeah. So when I look at the PayPal announcement, really, if I'm Kane and I am the CEO, head of Synthetics, I'm feeling the ultimate validation, right? So like here is this tech giant, and here they are creating a centralized version of my protocol, right? Like when you look at PayPal and cryptocurrency, it's exposure that they added. And when you look at Synthetics and you look at, when you go into Synthetics DApp and their exchange, what are you purchasing? What are the Synthetics? It's synthetic exposure to certain asset classes. And so it's like, if it's Kane and Synthetics on this side, like it's just like, man, what a dream, what an innovation. And as soon as it's PayPal and they're doing it, with kind of a very scoped focus, it's like, it's just not enough. It's just not, it's not there yet. But like, anybody who sent their iPad to Nigeria because they got scammed on Craigslist understands that like the scale that PayPal is dealing with is just ungodly. Like you just can't throw on a new technology like that, which has a history in, but is not the primary use case, with sort of nefarious uses being unrefundable. Like there's a reason that hackers, when they take control of your computer and lock it down, that they're going to demand that you send them Bitcoin, because it can't be reversed. PayPal doesn't need to expose themselves to that type of customer service burden on day one. So one, it's absolutely fantastic for cryptocurrency and broader adoption. Hopefully because they're doing more than just Bitcoin, will be able to show people that cryptocurrency does not equal Bitcoin, and the two terms are not necessarily synonymous. Although Bitcoin deserves, as the granddaddy of all crypto, to always be, coupled with any sort of decentralized currency. So I think it's wonderful. I think that it's only going to help grow awareness, and yeah, I think everybody who's been in crypto is going to be really frustrated. But guess what? They weren't going after you in the first place. They're responding to the competition from Square Cash and sort of other players in digital payments who are offering you exposure to digital currencies already within your stock trading apps and these types of alternative product offerings. So it's a good sign that in order to remain competitive, that PayPal has to offer exposure to these digital currencies.
Is PayPal even going to buy any actual Bitcoin? I mean, is it all going to be just a price peg essentially, where like, all right, I'm buying one Bitcoin and then my value is pegged to a Bitcoin, or are they actually buying a Bitcoin on the network and holding it for you, or is it merely just a price peg?
Well, let's think about this and look at the incentives. So certainly I haven't read the fine print enough to know definitively, but my guess would be that yes, they're buying and holding, a large chunk of this that, if they were audited, it would be on the books. And that sum needs to be equal to or greater than the actual holdings of their customers. But when you look at it, this is kind of the stablecoin model, right? Mm-hmm. So, for example, whenever, let's use Coinbase USDC or Binance, who uses a partner company to issue their BUSD. Essentially, I'll pretend to be Coinbase in this example. You give me dollar bills and I will put them in my money market account or bank account. And then I will issue this digital token and I'll follow all the KYC, AML rules. And it's just like genius, because I get to earn market rate returns on your money while you go get to play on the blockchain. So that's why, I mean, we have not even begun to see how many stable coins are really going to emerge. Like this is just the beginning. Every legitimate large project is going to have their own stable coin, I think, in the next 5 years. And there's going to be a huge forex for just these stable coins and that small arbitrage opportunity as the chains they're on become more efficient, or as they just leverage centralized entities that are already very, very efficient. So with these stable coins, you give me your money and I get to essentially go and invest it. Some investments, like bonds, are actually you lending out organizations money that predictably bring a return. And so look at this. PayPal is sitting on all this Bitcoin, all this cryptocurrency. And guess what's really hot? Is being able to lend cryptocurrency. So like, if you look at like BlockFi or Celsius, you look at MainFrame, Aave, Compound, like lending is a fundamental financial primitive that is necessary in order for an economy to mature. And so PayPal's sitting in a huge position where, yeah, you're buying Bitcoin and you have exposure to it, but then, they're in a position they can lend it out and earn a return on it. And so it's like, it's kind of a no-brainer in my mind, as long as there's sufficient demand for these assets. And I think all these lending protocols show that if there's not today, it's certainly going to be here in the short future.
And so, I mean, that does seem like a tremendous opportunity for PayPal, to not let all this Bitcoin sit idly by. Do you foresee them entering and utilizing some of these lending protocols, whether MainFrame or Aave or anything else, or do you see them actually building their own competitor that they could rely on as an institution?
So, well, we know that PayPal is looking at exploring purchasing some, crypto institutions. I think BitGo was named as one of them that was, in talks. So certainly they're after the talent that's going to really know the space well. But when I look at PayPal's game, it's a very centralized game, and they prefer the world of legalese and the court system, because that's a game where they can always win at, right? Like they've got a treasury of just lawyers that they can throw at you. And so in my mind, they're going to be leveraging services, of a BlockFi equivalent. Like I think BlockFi is subsidizing returns to help grow their user base, but like they will prefer centralized entities because they can go after that entity in the courts. Now, as soon as you put it into on chain, then you're exposed to smart contract risks, like we saw with Harvest, and it's just not ready for PayPal. It's not ready for any. I mean, it's honestly, it's almost not ready for the VC money that's already parking it there. I was on the phone with a firm yesterday who talked about how they, they're a market making company, and so they help create efficient markets for token projects, and they take their own treasury and park it in different liquidity mining programs, and it's just all about yield for them. They'll park it in, they'll extract value, and then they'll pull out. And so for them, it's just like they actually have one or two people that go through and try and audit the smart contracts, but I think that's insufficient. I think you're going to start to see in 1 to 2 year time frame where we're going to get a lot more mature and a lot more serious about what was introduced to us with the Y volts from Andre and these projects that are basically creating strategies for you to trade certain, you're buying exposure to certain strategies. And in my mind, the only place, if I've got $100 million to park within blockchain, the only place I'm headed is to protocols that are formally verified. And off the top of my head, the big ones are Uniswap and Compound. And so we built, at MainFrame, we built our protocol specifically with the foundation that we can get there very quickly, so that you've got Uniswap, Compound, and MainFrame, and you've got your market making, your variable rate interest, and then fixed rate interest with MainFrame that meets that gold standard of being mathematically proven to have certain, you can't say it's ever hack free, but it's mathematically proven to have certain predictable behaviors with formal verification. So you have the highest degree of assurity that we have available to us right now.
And do you think that you guys are a lending protocol? Do you think that theoretically, if PayPal does actually have to buy the Bitcoin and hold it, that is then making very illiquid. That's making all that Bitcoin illiquid. It's not moving anywhere. They're holding it, but yet they do have the ability then to go and lend it out. So now all of a sudden, on the Bitcoin lending market, just gets flooded with this massive supply of Bitcoin that is available to be lent. Will that affect the business models of even decentralized lending protocols like yours and others? This potentially massive influx of cryptocurrencies that are available for lending?
So not in the short term, because one, if so, we're kind of asserting a lot of things that you and I don't know a lot of, just kind of looking at the incentives that exist and kind of predicting rational behavior. But so if I'm going to use that same logical thought here, then PayPal is only going to expose a certain percentage of their portfolio onto those risks, right? And so one, it's not going to be everything, because nothing, if there's an upside that is typically indicative of a risk, that's why you're earning a return. And so, they would only do it with a percentage. And then two, PayPal has access to opportunities that you and I don't. And so in order for them to have a direct impact on, let's say that MainFrame is supporting the WBTC collateral type. In order for us to see a collapse in demand for borrowing against WBTC, then there needs to be some class of people who are already participating on MainFrame and that now have access to this PayPal borrowing on their end. And PayPal's not going to be lending directly to people, and MainFrame is not in the short term going to be lending out to large institutions. And so I think there's a very distinct line in the sand that probably won't be crossed for some time. But honestly, like the Bitcoin is one of these assets that if there is a lot of liquidity on the lending markets, that's a really good thing, because people, in the United States, we enjoy much lower interest rates than most of the world. And if you look at Brazil and trying to finance a refrigerator, you're sometimes paying upwards of 60% APR on financing a refrigerator. And so somebody who is tech savvy in Brazil, who's acquired Bitcoin, can leverage these lending protocols to then finance a refrigerator for their family. And that's not a crazy idea that we're not very far out. Like I think within the next 12 months, like this is going to be very, very possible. And I think that if PayPal were to keep interest rates low with a huge supply, there's a certain demographic that is going to benefit. Now, that demographic is not your yield farmers that are, I don't park money in anything less than 25% APY. Those types of guys, they're going to go find some other new, borrowing against their CryptoKitty NFTs. Like that's, a really niche market that, they're promoting and shilling on Twitter that people are like, oh, this is crazy, let's go try it out. And, in the meantime, the guy who's created it is really raking it in for the first 2 months. So there's always going to be opportunists exploiting nascent markets, and it just changes the dynamic of the market, even if it does impact us, and there will be beneficiaries.
And building off what we were talking, or in contrasting to what we were talking about last time, where we were discussing how it seemingly DeFi was just taking centralized financial products and then putting them in decentralized protocols, but essentially mirroring a lot of DeFi was just essentially mirroring the same products that existed in CeFi. But I wanted to pick your brain a little bit about flash loans, because it seems like flash loans seems to be one of the first real products that I've seen that can't be done in centralized finance. It essentially is inherent or is only available in DeFi, which excites me. What's your thoughts on flash loans?
So I think flash loans occur. So I think if you break down more abstractly to what a flash loan is, I think what you're going to find is that it is happening, but the world doesn't work in block time, right? Like you don't have 15-second or 30-second intervals that you have to get a transaction done by. And so if you looked at blocks as like a day, there are short-term loans and there are short-term loan vehicles that you can leverage. And if I were to say, for example, if you've got a certain expertise, let's say you're really good at we can use one from pop culture right now. So Logan Paul is really getting into Pokemon cards. He's collecting them. And so if you've got a really rare Pokemon card, I bet your rich uncle will, you find an opportunity online to buy this and you can flip it for a quick 50% profit. I bet you your uncle, if you explain to him the deal, would agree to that protocol, give you the $50,000 you need to buy the Charizard, whatever, and then you turn around and flip it on eBay for the increased price. But if you walk up to your uncle and you show him that yesterday one of these cards sold for $100,000 and that your buddy is selling it for $50,000, your uncle's probably going to jump on board because he's going to be able to take a cut of that. So flash loans just give some finality to it, and the thing is, you don't have to know a rich uncle. So in that way, it's enabling. So anybody with the smarts and the solidity knowledge, all of a sudden can be a millionaire for a second. And so it's more fascinating, and we're going to see more of these types of behaviors where you can exploit at scale economic inefficiencies or economic unintended bugs or unintended consequences of protocols oversight.
Well, yeah. So those are two talking points, and let's separate them individually. One being the ability to exploit inefficiencies in the markets really quickly at mass, and then the other being the one I want to continue speaking about for now, at least, is this idea of flash loans, though, of the finality, but it only going through, you only getting the loan if you actually complete that profit making that you want. As in, it's seemingly a win-win where the giver of the loan is only giving a loan if he knows at the same moment he's giving a loan, he's getting it back. So there's no real risk, at least loan-wise, on him.
Mm-hmm.
And then the taker of the loan also isn't taking any risk because he knows that he's making a profit, or at least could pay back the loan the second he takes it. So while there are similar ideas, while there is a can't lose deal, like you mentioned, with the uncle, where I'm telling you, I'm going to be able to sell this because I'm almost certain. But with the flash loan, you actually get certainty on your loan. And I think that's the thing that has the real potential to be groundbreaking. Is there a loser in the flash loan system?
Well, if the scope of the conversation is only between the person who's flash loaning and the liquidity pool they're pulling from, you would assert that there's a potential loser, and the potential loser would be the person who's actually running the function. Because if you run, let's say that you're arbing between two markets, and the opportunity might execute, but there might be zero profit for you. And in fact, you might lose a little on the gas fee. So there is the potential of losing, but you might think, well, rationally, if I'm looking at the opportunity, the only way that I end up in that circumstance is, one, I'm running a liquidation bot, like altruistically, like within MainFrame might liquidate positions and use flash loans to liquidate those positions. And we're just not in it for the profit. We're in it to make sure the protocol stays, under collateralized or over collateralized. And so, but yeah, we could lose out on some gas fees that were, that's just a cost of doing business there. And then, but the short answer is kind of no, but it is very similar to kind of wholesaling real estate, though. If you look at, you find a piece of property, you could put it under contract and then go resell that contract to a flipper who's going to, give you more than what you agreed with the owner of the property. And really, it would be like you're looking at paper, you took pictures of the property, and you told the owner, hey, I think I could do a deal here, but before we put you under contract, I'm going to go talk to my fellow investor associates, and then you go basically sell people on it, and you represent that you've got it under contract, and you can kind of create that same scenario where it's like you only go get that contract once you've got a buyer on the other side, and you got your 10 to 50 grand difference from wholesaling the property. So I think that the not a lot in DeFi is truly novel, and at least yet. There are a couple of different places, like. For example, MainFrame owns Sablier, our streaming protocol. We hit a milestone of over $50 million in assets under management since we talked last. And the thing is, I don't see the ability to stream money anywhere in the centralized world. So I would say like that's a truly novel DeFi type product. The flash loans, anything that is too novel it comes with this barrier to entry where you've got to teach or change behaviors of consumers, which is a very difficult task to do. And so it's I think the reason we're seeing so much traction within DeFi is because it is the one area of blockchain where people get it. They know what fixed rate loans are, because they have a mortgage or a similar type vehicle. They know what a variable rate loan is because they've seen interest rates change in the marketplace. And so, I think in terms of flash loans, it's very interesting and it's novel. But I think the novel part of it is that you and I didn't have access to millions of dollars of credit or tens of millions of dollars in credit from any of our uncles because they're just not that rich.
Right. I mean, definitely not my uncles, but I love you guys anyway. Now it's very interesting, and then let's talk about the market efficiency side. where, instantaneously market inefficiencies could be taken advantage of so people can make money. But on the positive end, the imbalanced markets could be made, efficient instantaneously. I mean, arbitrage and corrections could happen. So do you see that as an overall positive thing, that this will expedite the maturity of the market and the efficiency of the market to almost, I almost see a future where this will all be automated, where, you kind of see this in the stock market with the high frequency trading. That was a novel idea where, stock trading went from a guy with a piece of paper in the pit throwing it, and it was so slow to just bot trading, where if you really where there was thousands of transactions, I don't know the numbers happening every millisecond. Will we see a similar effect here, where kind of the speed of which the market inefficiencies could be taken advantage of will lead to the market being more efficient?
Yeah, I mean, we're already seeing this within the mempool of Ethereum, where I think it was Dan Robinson who actually published a piece that sort of talked about these generalized arbitrage bots, where you submit a transaction to the mempool, and you've got these bots that essentially take the inputs of your transaction and they replace the inputs with their own beneficiary accounts, and because the state of the blockchain is already known to everybody, they can see and calculate whether or not that's going to bring any benefit to them. So as soon as you put a transaction out, if there is a significant benefit to yourself, it's not secret. It's something that in fact is very public, and it's kind of like putting out an auction. If you're at a car auction and you're standing by the red Corvette, somebody can tell you're interested in that, and they might wonder, well, why are you interested in it? And then they pull out their phone and they see that, like, oh, that's a really good deal, and you can make a quick 10K, and so they're just going to outbid you up to 10K, that until that margin gets really, really low. Low margins are great for consumers, and so in terms of mass adoption, you're going to see the yield really come down, and hopefully that's a result of these type of efficiencies. But yeah, are people going to be sad that it sort of disincentivizes innovation? You do all this research, and then you put this transaction out to the blockchain, and then some generalized bot comes along and just steals it from you. Yeah, you're not going to put all that effort in next time, and so you're probably going to make friends with a miner. And
luckily, that's another thing where we're talking about big financial tools, and as we see, technology is never perfect, and right. hiccups could happen, and when hiccups happen, and definitely when it's talking about big finance, that could be an issue. But we're talking about this idea of that you kind of, it seems to be that the power is going more into the miners' hands in this situation, where it's like you said, someone finds a great opportunity for a profit-making transaction, and the miner just scans the mempool and replaces the input with his own. That seems like the balance of power, which it seems like a constant battle between miners and nodes and users. It seems like that would shift more towards the miners' direction.
Yeah, so you look at and so this is where it starts to get interesting with like user-owned type of projects. So if you look at the shift that Ethereum 2.0 is going to introduce, is people who hold Ethereum all of a sudden can become the miner. We're gonna this whole transition is going to take several years, which you want it to whenever you've got as much asset under management as Ethereum does, and so really, so we looked at this, right? There's this concept of miner extractable value, where the miner can front run the transactions, and you sort of expect this sort of thing from businesses today. I couldn't trade for free on Robinhood unless they were selling my information to high frequency traders, and I prefer that. And in this case, like, I don't mind that some business is finding that I like to purchase shares of Tesla, an unreasonable type of, like, I'm not, I choose Tesla and I just buy Tesla shares. Like, Cool. Someone wants to pay for that information. Good for them. And then I get this free service for it. And so you kind of have to expect that in order for the prices of these services to come the lowest, that they need to find additional revenue streams. But when you look at the transition that Ethereum's going through, by adding proof of stake, anybody who holds the minimum amount of Ethereum, or that pulls it together to create that minimum amount of Ethereum and is willing to put it at stake, will be the miner. And so eventually there'll be a shift in power back to the users, because miners are users. They're just a different class of user, and we're gonna kind of merge with the miners and get our incentives really aligned. So it's a short-term problem, but soon you'll have the same opportunity.
Yeah, well, we're talking about Ethereum 2.0. I don't know how short-term of a problem it is. We've been hearing about ETH 2.0 launching for quite a long time. I sure hope it's a short-term problem, but I mean, they're announcing the beacon, but I mean, like you said, it's going to be a really slow process because they want to be careful here because of the amount of assets, and I think that's right. So last question before I let you go. This is the Halloween-themed conference we have here, Tales from the Crypto. And so I want to ask you, all the interviewees, what is your scariest crypto story?
That's interesting, because I'm quite calculated in terms of what type of exposure that I put myself into. I've never. Well, I mean, I've got one. So I was in charge of MainFrame's ICO, and so I was actually helping run the scripts that was sending out the MFT to different players. And as I was going through these different batches, and we were trying to be very methodical about it and go from one batch to the next, something I'm human, something got mixed up, and I think I ran the same batch twice. And so this was just after I had joined MainFrame. I think I'd been there for like 2 or 3 months, and I was going through this process. And so a couple of people out there, I think ended up with double the amount of MFT. And I just remember just feeling like a dog with his, tail between his legs, and going back to Mick at the time and telling him, like, dude, we gave out too much MFT. And he's just like, why did it happen? And I was just like, honestly, it just comes down to, like, as I was going through each batch, I just did one batch too much. And so I mean, that's kind of the scariest things, because I mean, depends on where you're at. Like, at the time, it felt like, oh man, like I might lose my job. It was in the thousands of dollars, but I don't think it was in the hundreds of thousands of dollars. And so at the time, it was kind of scary to me. But these types of things, there's a reason why you send that test transaction, and it's so that you can get confirmation that everything's right. But I, as high of affinity for risk that I have, I am taking very calculated risks and exposure. And if I'm doing something, like FOMOing into some yield farm, I'm doing it with stuff that I know I can lose. I just, I've been through 2017. I've had the emotional roller coaster, and I try not to put myself in a position where if this thing doesn't behave like I expect it to, I'm not devastated. And so, knock on wood, I hope it remains that way. And but we'll see.
Yeah, well, that's why you are, you do seem to be very calculated. Definitely, when I speak to you, I could tell. So that's why I very much do enjoy speaking to Doug. As always, I appreciate you taking the time and giving your thoughts on the latest happenings in the crypto sphere. And I can't wait till next time. Congratulations on the launch of the testnet and passing $50 million of streaming money. Looking forward to speaking to you next time, Doug. And for all of our viewers here at REIMAGINE 2020, I'm Yonah Hochhauser. Thanks for watching.